Here you've got
Yes.
McDonald's at a 3.3% risk, and then we've got the dividend.
3.3
Yeah, that's right.
dividend yield.
That's right.
There's no risk at all.
Yeah, well, we're using a 6-month option on this one instead of a year option, so we'd really only get what?
Oh, I see.
Yeah, 1.7, 1.8, but still, that's paying for more than half of your at-risk amount. Okay. Now we don't like to. I don't know. I can't speak for Kurt, but I specifically do look for dividend-paying stocks, but I don't look for the dividends to be equal to the maximum risk. I figure the dividends are just a little bit extra once I've gotten into the position. But that's just me personally. Now, just because this McDonald's position is at the top of the list, does this mean this is the position you should jump into right away? No, you want to further do your research, do your analysis. So from Power Options, once you've found the trade, simply click the little blue button. You can go right to the stock chart. We can look up company information to see any news or earnings events coming up. I can look at the option chain. Now, one thing I can also do is if I click on search by symbol, this will take me to the McDonald's page for the married puts, where it's showing me all the potential trades that I could make. See, I could also go with the June 75. This is a little bit more in the money than we normally like to do, but all the math is here for me. So if I decide I like to use McDonald's, I can go to this page. Maybe I'm more comfortable with the June 65 if the stock's trading at 59.57. Well, sure, I add a little bit more risk to it, but it might give me a little bit more leverage to use some of the, I shouldn't say leverage, it might give me a little bit more advantage to use some of those income methods quicker if my strike price is a little bit lower, but I am taking on more risk, of course. But this allows you to quickly compare. Once you've decided maybe McDonald's looks good and you like this 3.3% risk, this will allow you to quickly compare. Now, another thing that's useful, of course, I just mentioned that we saw McDonald's had that 3.3% risk. I'm sorry, 3.3% risk, and we were looking at a 3.3% dividend yield here. But if I wanted to go out in time and I wanted to know what the 2010 Leafs would be, I simply change the date here. And look at this now. The 75, January 2010, has a 4.8% risk with that 3.3% dividend. So I'd be in it for almost the whole year, and I would get most of that 3.3% dividend, wouldn't I?
How about that?
Yeah, this just allows you to quickly compare and look at the different ones that match your criteria. Again, the radioactive setup that Kurt and Ernie put together is not a direct recommendation. You want to do your own research, and you also want to use that as a stepping stone to create your own personal search. Put in what you like to see, but always use this method to limit your risk. Now, once I've found the trade, I can quickly link it here into the portfolio. Okay, I can add it directly to the portfolio so I can start paper trading and tracking. And if I go into the portfolio here, I want to look at a couple things. I'm just going to start off with my craft position. What I want to go into is this December 9th trade view. Okay, here I have two married puts. Oh, I'm sorry, this is actually the wrong one. I apologize. I believe it's this one here. Is this the one I want? Yeah, there we go. Kurt's seen these trades a couple times. I've been mentioning them. What I have here is back in October, I entered into two married put positions, one on Johnson & Johnson when the stock was trading at around 63.50. Okay, I bought a put option, the April 70 put, for $9.80 at the time. Well, now the stock has dropped slightly, and my put has gained in value. But if I wanted to know what could be done with this position now, I can simply click this More Information button in the portfolio and go to Position Analysis. What the Position Analysis field is going to do for me, it's going to break down that Johnson & Johnson position based on my original numbers and where I stand now. So I have that information right here. My total max risk was only 4.5%. Okay, but as I scroll further down the page, I can see my current liquidation value. I'd have a loss of about 3.8%. And if I held it to expiration and did nothing, and the stock stayed at the same price, right now I'd expect a loss of 4.6%. But underneath, what we've done for you is given some suggestions based on Kurt's unique technique of some income methods you could do to lower your risk or maneuver the put to a longer time frame. See, here I could increase my risk by applying what's called income method number 9, but I've given myself more time. I could sell to close my current put and buy to open this January 2010 put, and what that would do is give me more time to manage the position. Okay, it's one of the income methods that wasn't discussed today, but is available. Now, a better example we could do, of course, is look at the St. Jude's position here, Kurt, and we originally bought St. Jude's at $27.85, and purchased the put option, the April 45 put, for $16. Well, the stock's moved up 11.2%, and of course we've lost money on the put as well. It's not one-to-one, but we've lost about $405 on the put, gained $600 on the stock. Now this is where we can see some of the information we looked at today. So now I want to know, what can I do to get more money out of this position? The stock has moved up 11%. It's probably well past time to act, but we want to make some action on this now, don't we, Kurt?
Right.
So I'll link to that position analysis page. Again, it'll show me my basic position view and where my position stands right now. And as I scroll to the bottom, hey, look at this, Kurt. This is kind of unique. We got a little
bulletproof.
It's telling me it's already bulletproof, but I can still do more things on it because I still have several months to go. And down here at the bottom, in our rollout opportunities, we could use income method number 3. We could roll the put in time. And Kurt's going to elaborate on that in just a few minutes. Okay? And I'm going to scroll down a little bit more, and there's some other income methods I could use. Check out the bottom here, Kurt. I could apply income method number 6.
6.
Especially, I could sell the 35 call on St. Jude and buy the 40, give me a net credit of 40 cents, and put me at a negative max risk, an increased negative max risk, or increased bulletproofing. Is that really a term?
You'll lock in more income. Yeah,
that's right.
That's why we call them income methods, sure.
That's right. To go down to 3.6%. So what
We're going to explain income method 3 here in just a moment. So.
That's right.
Okay.
What I just wanted to show everyone is these are the ways, we're talking about this very unique and very useful. I don't want to say useful. That's just a bland term for what this technique does. I mean, I had a position that I'm going to give Kurt the write-up on. We might post it on the blog there on OfficeMax, where I bought OfficeMax back in April actually, with a married put position. I closed the position in November. The stock was actually down about 65% at one. It was actually down 80% at one point from where I purchased it. But I closed it in November for about a 5.5% gain, with the stock still being down 50%, because I had the put option in place and used Kurt's income methods.
How about that?
Even though these tools on Power Options are greatly going to help you reduce your time, you can screen specifically for those married puts that match what you want to trade in your risk tolerance. And then when you're tracking them in the portfolio, you can see some of the opportunities with the income methods. The only way to fully grasp the income methods and have a full understanding of this methodology is, of course, to buy the blueprint. And, we talked earlier, and Kurt said how, anyone can learn how to trade a covered call, and that's why we give income method 1 away for free. But you can do it the wrong way. If you don't know the techniques, you can do it the wrong way. Let me explain why. This position here is a position I actually got into. I bought Kraft on December 23rd for $26.29, and at the same time, I bought the June 30 put for $4.80. Okay, so my maximum risk on this position was $1.09. The most I could lose was $1.09 or 3.5%. Okay? Now, right now, if I had left this position alone, I could even liquidate the position right now for 1.2% gain. Kraft has done really well. It's gone up to $28.99, almost $29. And my put options lost a little bit, but I essentially have a gain here of 1%, or about $59. Okay? What did I do, Kurt? Now this is
you sold a call against.
No, not only did I do that, not only did I do it too early. Look at the strike price.
Too low a strike.
That's right.
Right.
So when we income method number 1, the correct way to do it is described in the blueprint. Here I jumped the shark, any euphemism you want to use there, and I sold the 27.5 call for 95 cents. Now, it was a good premium. I only had $1.09 at risk, and I sold the 27.5 call for 95 cents. So I was almost bulletproof, but I was almost bulletproof in the incorrect way. See, the stock's going up above my strike price. I'm at risk of getting assigned at 27.5. It's going to cost me $2.25 to buy back this particular call option. So now this position, this collar spread, with the incorrect use of income method number 1, instead of being at a 1.2% gain, is actually at a loss of 3.1% because I have to maneuver the call. I didn't do it correctly in the first place, so maneuvering the call is going to be much more difficult. Now I'm going to keep Kurt updated with this trade as I go. We actually had a customer email in this morning who asked about getting into a Kraft position today. And I actually wrote him and said that, he was asking what should I do now if I did get into this position. And I answered him honestly, what I should have done on this position is waited till almost today. Actually, probably waited a little bit longer. Because if Kraft keeps this going in a couple days, if it's up around $29.50, that's going to be the perfect opportunity to sell the February 30 strike call. One of the correct ways to use income method number 1. I'm almost going to collect the same premium because that February 30 call is trading for 70 cents today. So if it's up to $29.50, I might be able to get that for about 95 cents again. I'm going to be in a much better position. But right now, I'm actually at added more risk. I've taken more loss on this position because I reacted too fast and I didn't follow the rules of the master. I must admit, shame, Kurt, I did not follow the rules of the master. I cheated. I tried to outsmart the master, and now I'm